You can spend, you can save. What is the right thing to do? Federal benefits, thrift savings plans too. You can save your own way. With help from Micah and Tammy, you can save your own way. Save your own way.
Welcome back to another amazing episode of the Plan Your Federal Retirement podcast. I'm your co-host, Micah Shilanski, and with me today, not Tammy Flanagan as usual, but we have another legendary person, speaker, presenter in our recording studio today. We have the one and only Floyd Shilanski. Pops, how's it going?
You know, I am blessed to be here, and it's another day in paradise. Thanks for inviting me to come on.
Man, this is fantastic. Well, if you didn't recognize by the name or by Pops, yes, Floyd is my father. He started our financial planning firm. Well, he started really first in financial planning in 1978, a couple iterations here and there, and brought us into the business, which we're very, very grateful for. So thanks, Pops.
You know, looking back in my career, I'm glad I did what I did. All right. You guys have just, you and your sister, Jamie, have just done phenomenal things in here, and we've helped so many people, especially in the federal market.
Mm-hmm. Yeah, the federal employees, and that's really what our passion has moved into throughout the years. And there's so much incorrect information out there about federal employee benefits, which is a big reason that we're doing this podcast. As our listeners know, we have a goal as a team that we want to help over 1 million federal employees with their retirement. That's a huge number, right? So we definitely need your help and our listeners' help sending this information out, etc. Now, listeners, if you have not filled out our listener survey, we would love your help in doing that. Jump on our website, planyourfederalretirement.com, fill out that listener survey so we can get your feedback, because this podcast is all about providing benefits to you. But if we don't know your feedback, that's hard to do. We have to make up our own things. But in the meantime, while we're waiting on that great feedback coming in from you guys, Pops, I know one of the things that we were talking about, and one of the questions that we get all the time when working one-on-one with our financial planning clients is that question on Social Security. And Social Security, I'm going to say, is a really important question because, as you know, federal employees, their benefits are based on three things, right? They have their federal benefits, their pension, Social Security, and the TSP, the Thrift Savings Plan. Those are kind of the three tiers which make up the first federal employee retirement system benefits package. And that Social Security is a big one because we have options. We have different ways that we can take that. And there's a little bit of misconception sometimes out there, or at least when I'm talking to people about this. But what are your thoughts on that, Pops?
You know, over the last 40 some odd years I've been doing this, the ebb and flow of Social Security has been, it won't be there, it will be there, it won't be there, it will be there. And then when CSRS and FERS shifted in the mid-'80s, I guess it was, a lot of the conversation with our federal employees were, do I stay with the old system or go with the new ones?
Right.
And I will tell you today, some of the ones that stayed or say, oh, that was the best thing I've ever did. And on the other hand, some of our FERS clients go, best thing I ever did was get out of that system because now I can control it, right? Funny thing about Social Security, though, 40 years ago, many of the people planning their futures, again, CSRSers, I don't have it, I'm not worried about it. And so they set aside their own funds to mimic what the Social Security would be at that time. First, guys and gals, it was mandated that it went in there, all right? So it has become an integral part of the retirement system. The question I see a lot, and that we talk to our clients a lot, do I turn it on at 62? That's the first year that you're eligible.
Sure.
Unless you're a surviving spouse or something has happened, right? And then you have this thing called full retirement age, and planners call it FRA, right? And that's all based about the years that you were born. And then the hot topic that I've had recently, well, you know, Floyd, Social Security isn't going to be there when I get ready to retire.
Now, Pops, before you go any further, so the FRA, the full retirement age, that's generally between 65 and 67, right?
Correct.
So between 65 and 67, depending on when you're born, most people that haven't retired yet, that's 66 or later, is probably that full retirement age for them on average, but that is identified on your Social Security statement. You can pull that and see what that is.
That's correct. If you apply for Social Security and start receiving it before your full retirement age, you get dinged. It starts at a 20% permanent penalty, and it works its way down until you hit the full retirement age. Conversely, if you delay after full retirement age, you get an increase in that benefit every year, and it's guaranteed, plus COLA. So this last year in 2022, people that delayed taking Social Security, say from 67 till 70, they got a double-digit increase in benefits. Stock market didn't do that in 2022. So I try to get my clients, or the people that we talk to listen and say guarantee versus risk, right? If you want to guarantee, increase that income, maybe you want to delay. Now, that delaying comes with a risk. Will Social Security be fully funded by the time we get to 2035? And the answer is, that depends, right? Will Congress bite the bullet and do something to fix it? But this isn't the first time you've been here, Micah. We've had to work on Social Security and fixing it multiple times, even since you've been born.
Yeah, and by fixing it, we're just kicking the can down the road. I mean, it's just to the next thing, to the next thing, to the next thing, et cetera. So, all right, so you've painted a complex picture there. Let's start pulling the threads on this one step at a time. So you got a couple of questions. One, when do I file for Social Security? Two, what's the benefits, pros and cons for filing early or delaying filing? And I guess in a subset of that would be, is Social Security going to go away at some point in time? And lots of great questions there. So let's take that last one. Let's kind of punt that. I mean, that's what Congress does anyways, right? They punt that decision. Let's
kick
do that
it down the road again.
Let's kick it down to the road to the end of the podcast. Give our listeners a good reason to stick on to get our opinions on that one. But before we get into that, really when I'm sitting down and working with clients and Pops, I'd love to know your thoughts on this or where you disagree. Turning on Social Security, number one, is a cash flow question. That's the number one way that I look at this. And I think so often that federal employees can get caught up looking at spreadsheets, looking at numbers, looking at, what's my break evens at 82 or this or that, and says, no. First thing we got to look at is just your cash flow. Cash flow is the heartbeat of retirement. And that means if you have solid cash flow coming in, you're able to do some really fun things in retirement. And if you don't have solid cash flow, you can't do fun things in retirement. So the first thing we have to look at is cash flow. How much a month are you spending? Where's that money going to? And where is that money coming from? How much is your pension? How much would be Social Security, et cetera? Those things I want to look at first before we even get onto a Social Security conversation. What are your thoughts on that?
Don't forget the emotional side.
Yeah.
And so many of our I call them early retirees, people that want to punch out at 62 and say, we're done. All right. The question is, what are you going to do? You're going to go live off the grid in a hermit? Well, okay, maybe 62 makes sense. But so many times it's the emotional decision. It's my money. I want it now. That's one. Two, I don't trust the government. It won't be there when I get there. Well, that's another one. All right. But let's talk back to your cash flow side. If we start before our FRA, full retirement age, the recipients are permanently penalized.
Yep.
With one exception. During the first year, you can turn it off and go, oh man, did I make a mistake? And suspend it, and you can delay it. You will get some of your money back, but if you had taxes withheld, you don't get that back, which makes it a little more complicated and a little more on the financial side versus just the emotional side. And then to speak to what you were talking about, cash flow-wise, that guaranteed every year 7% plus COLA, that's pretty exciting stuff from a guaranteed position.
Yeah, so let's break that down just a little bit. So we have a couple of things that are moving there. One is the cash flow question: where's your money going to come from? And so often I get clients that are going to look at this and says, "Oh, well, I'm giving up ABC money if I don't turn my Social Security on now." It says, "Okay, well, hold on a second. If we're planning on spending $8,000 a month, and that's going to be good cash flow, net after taxes, money to you, you feel good. Does it matter where it comes from if you're getting $8,000 a month net?" Just for a quick emotional conversation, not a planning conversation. And most of the time the answer is no. As long as there's $8,000 a month net hitting my checking account, everything's good. Okay, great. Well, then fantastic. Now we have to look at this and say mathematically, where is the best place to pull money from? And then Pops, I love to use your scenario that says like, every year you delay Social Security, it is guaranteed to increase. Now, we use that G word here because we can't use it somewhere else. Now, the TSP G fund that you guys have in the G fund is fantastic. It's guaranteed it will not lose money, but it's not guaranteed it will make money. Now, most of the time it's paying a positive interest rate, right? It always has, but that doesn't mean it's paying a great interest rate. I mean, for years, the interest rate in the TSP has been really low. Now it's starting to increase as rates have come up. But if we delay your Social Security, you're getting a much larger increase, right? So if I had a choice, I had money in the G fund that's paying a whopping, I don't know what it is right now. Let's say it's 2.5%, 3%. You're paying 3% in the G fund, or I have Social Security, which every year I choose to delay it is growing between 6 and 8%, depending on when you're deferring it, et cetera. Okay, well, let's take the lower of the two. Let's say Social Security is only growing by 6%. Well, which investment do I want to keep? And which investment do I want to cash out? Do I want to cash out the one that's paying 3%? Or do I want to cash out the one paying 6%? Well, the one paying 3%, right? I'd rather give up that lower return in order to get more money, a higher investment growth. And I think that's a way that people don't look at Social Security. They don't look at it as an investment return. If we took it out and we said, hey, look, I had $250,000, one's paying 3% and $250,000 in a bucket that's paying 7%, which one do you want? And they're like, I want the $250,000 at 7%. That's the bucket that I want. I don't want this thing at 3%, et cetera. Great news. You've just selected to delay your Social Security. Assuming we have other pots of money that we can pull from that has your cash flow to come in, and it makes financial sense to delay your Social Security, which we have to look at as well. That's a quick way to look at it.
100%. That's back to that conversation that we were talking about earlier, the emotional decision versus financial. So many times when individuals that don't deal with money every day, they make emotional decisions. Wait a minute, it's Social Security. I've already paid into it. I want it now. And they say, well, let's delay the G fund for later. Emotional, right? Mathematical, wait a minute, I can pull from a 2.5%, 3% rate of return and get a 6, 7, or 8% rate of return over here. Okay. Look at it from the math position, not the emotional side. And so many times investors, all right, someone's getting ready to retire, their whole world is kind of tipsy-turvy, right? Guaranteed income, all of a sudden I retire, my income goes down. How do I replace that income? Oh my God, can I do this? Can I do that? You and I both know that when people retire, they spend more money than when they were working because they're catching up on all the things they didn't do. Mm-hmm. So I like to refer to it as turning points. From the start, you said it's a cash flow question, guaranteed. So at 62, do I need the money? Maybe. Let's just say yes. Well, maybe we have to turn it on. Well, no, I don't think so. Fine, because after 62, whether it's 62 and a half, 63, 64 and a half, I can turn it on when I need it. So I like to say, hey, we have turning points for decisions, right? If you take an early retirement prior to age 60, there's 59 and a half, so we don't have penalties taking money out of things, right? So I mean, from the retirement side of the equation.
Right.
Okay. And then you've got age 62 is the next one. That's the next option, all right? And then you have FRA, full retirement age, and then you had age 70 for max benefits. So during that 10-year, 7-year, 4-year period of time, you have different options. But once you turn on Social Security, typically it's on. Very rarely, very seldom in my 40 years of doing this, I think I've only suspended it once we turned it on, maybe 3 times. People says, oh my God, Floyd, what did I do? Mm-hmm. I don't want to pay taxes on it. How do I roll it back? And then again, that first year, you have that opportunity.
Now, also with that, keep in mind, Social Security, it's not as you're saying before, it's not if I decide to wait at 62 and turn it on at 70, I got to wait 8 years. You can make that decision every single month. Every single month you go look at this and says, oops, I changed my mind. I want to contact Social Security and I want to turn this income on. So this is not like it's an irreversible decision. So when I have clients that are on the borderline between A and B, it says, should I turn it on? Should I not turn it on? Et cetera. I said, look, if you don't know, let's defer. Because we can always turn it on and start that income coming in. But it gets to a certain point, we can't shut that income off anymore. And now when we turn it on, we're locked into those benefits. Yes, we might get COLA in the future. Well, you are eligible to get COLA as it goes up. We don't know what COLA is going to be. All right, this last year was big, but many years it was 0. Several years it was negative, but yes, negative COLA, because what happened? You didn't get a rate increase and your Medicare Part B premium went up. Well, if all of a sudden, if my gross doesn't increase, but my expenses have gone up out of my paycheck, my net deposit is down. And so those are things that can happen in retirement time. So before we go to flip that switch on, I think it's the best decision. We got to look at that. We're just going to think about survivor benefits.
Oh, well, before we get to survivor benefits, how about I quit my job, working for the feds. I'm tired of it. I'm 64 years old. And then about 6 months into retirement, someone knocks on your door and says, hey, Micah, I like what you were doing over here. Come to work for me.
That's a great point.
And then all of a sudden, here's my Social Security, taxed at 80%. All right. You're on Medicare because you're over 65. And what happens to your Medicare expense payments as your income goes up? This little thing called IRMA. And all of a sudden, you find yourself paying $500 a month for Part A, I would say Part B, because Part A is paid for it, right? For Part B in Medicare, you can't turn that off. But it could have been affected by reapplying for Social Security or not applying for Social Security and delaying it.
Planning for retirement can be so confusing, even choosing the right date. Is it the 1st of the month? Is it the 30th? Is it January? Is it June? If you have questions about when is the best time to retire as a federal employee to maximize the most out of your benefits, take the guesswork out of it. Come listen to Tammy Flanagan and Micah Shilanski talk to federal employees across the country about when and how to choose. We'll be hosting an online course on March 1st, and if you want to register for this intense program, make sure you go to planyourfederalretirement.com to reserve your seat today.
Now, to just connect those dots for our listeners, Pops, the way that was affected is you retired, so you get your pension, you're no longer getting a paycheck, but now you're getting your federal pension coming in, then you turn Social Security income on, and let's say you turn it on for a year, we can't shut it off now. That income is now coming on, and let's call it 40 grand a year in income, 30 grand a year in Social Security income. Then you go get another job that's paying $120,000, $150,000 a year. Well, you add that plus your pension plus your IRMA, that Social Security might bump you up over that IRMA restriction, which is 194,000. Don't quote me these numbers, but 194,000-ish number is what it is. And so now all of a sudden your gross income, right, not after deductions, your gross income, that all gets added up. If you're above that number, your Medicare Part B premium, as you said, increases. It goes up. Now, there's some cases where if you would not have turned on your Social Security, that would not be the case. So does that mean taking Social Security early is a bad decision? No, make an informed decision. That's what we're going to push on. And most of the time, we are encouraging clients to delay their Social Security. Why? I'm getting a 6% at one point, 8%. If I delay it after my full retirement age, Social Security, let's say your full Social Security age is 67. Every year you delay it after 67, you have a guaranteed 8% increase every single year in your Social Security. That's fan-friggin-tastic. So sometimes we want to look at it from that perspective to say, hey, let's get that increase. Let's make sure that income is coming in.
Oh, 100%. And just recently, about last October, November, I met with someone. Hey, Floyd, we're retired. We punched out. We're going to take 6 months off. I'll see you around Christmas time. So he comes back to Alaska. We happen to meet up, and I says, all right, well, we got A, B, and C done. I did that. Great. Let's go through the numbers. And he was hesitant. And I looked at him. I go, okay, what aren't you telling me? I took a job, like $200,000 a year government contract. So now he's got his pension from the feds, all right? And all of a sudden, he's got this Social Security turned on. And I said, well, good news is you're under 6 months. We can turn it off. Oh, no, you can't. Well, you can, as we discussed a little earlier. There's some negative things about it, but you suspend it, and it dropped his income back down.
You have to repay it. That's the negative part of it.
Oh, that's
right.
That is exactly. And they don't take it out in the future. You do it now.
Correct.
Yeah. Yeah. So all these little things and nuances that go with it. And Micah, one of the things that really I get concerned about is because we see people come in every day that Google stuff and read only the first 3 lines of Google what they can't do. And they don't read the next 4 lines that says unless. So emotional versus financial, back where we started at the first.
And one of the things to think about too on the Social Security side of it is just remember this survivor benefit question, right? With survivor benefits, the way that it works is that husband and wife is when you're married, the surviving spouse gets the higher of the 2 benefits, but not both of the benefits. So I'm going to take example. My wife and I am the income earner. She stays at home with our kids. And so clearly her Social Security is going to be less than mine, right? I have more years I'm paying into it. So let's just say for discussion, my Social Security would be $3,000 a month. She is eligible for half of my Social Security, which is $1,500 a month, even though she hasn't paid in. So she would get, we're both retired, we would get $4,500 a month in Social Security income, my $3,000 plus her $1,500. That's the way it would work if we were retiring today. Now, God forbid, but I pass away, what's her income? She gets the higher of the 2, so she gets $3,000 a month. Now, no longer that extra $1,500 because she gets the higher. Now, if we change that scenario around and I say, hey, instead of applying at 67 like I did in my imaginary situation, what if I applied at 62? Okay, well, now I'm taking almost a 30% reduction in my benefits. And so now I'm quick math here. I'm getting $2,100-ish a month. Let's call it $2,000 a month in income. So that cost her $1,000 a month. Quick math here. I know it's slightly off, but it cost her about $1,000 a month in benefits is what she is losing because I turned my Social Security on for survivor benefits. Well, guess what? That's a lot of money. And now also what she claims on is going to be less as well. So, I mean, all these things kind of compound.
Well, exactly. We had a client, a year and a half ago. Husband passed away, 70, getting max benefits. Spouse was 61. So at 62, she goes to Social Security office wanting to turn it on. And they convinced her it was really a good idea. I met with her maybe a month or two after that, and we're going on. And I says, why'd you do this? And she said, well, the Social Security office says it'll compound better. And we go through the math. She says, oh, my God, they didn't explain it that way. So again, within a year, we're able to turn it off. All right. Now, cash flow wise, it's just, I'm going to say it was $1,000 a month. So she's going, Floyd, how do I place $1,000 a month? Okay, well, you're over 59 and a half. So we started taking money out of the IRA, $12,000, $24,000 to get her over the penalty phase.
Yep.
And now she's getting full benefits. Emotional decision versus financial decision. So for the listeners, very, very important to talk to an independent individual, whether it's, us or someone else that gives you financial information and can quell your emotional conversation. Talk to the emotions, not at them, talk to them.
And that's a good thing. Whenever you're talking to your benefits personnel, the TSP office, the Social Security office, et cetera, I'm not ragging on them. These benefits are complex, right? It's so easy to have a simple scenario and say, oh, it's not that complicated, until you start throwing exceptions and what ifs, and all these things kind of build on each other. And that's what makes planning this a little challenging, which is why we have a goal of helping so many federal employees, because we want to make this less challenging. But we can't just take information in a silo and say, oh, because I talked to the TSP, I should do this. Oh, because I talked to Social Security, I should do this, et cetera. Social Security office could be great in answering a lot of questions, but they don't step back and look at the bigger picture. Easy example, what's your tax rate going to be when you have to take your new RMDs? Now, I say new because of Secure Act 2.0, depending on your age, between 73 now and 75, you have to start taking your RMDs. So now you have to start taking RMDs. Well, at 73, you already have taken Social Security. What impact is that going to have in your net cash flow? If your taxes go up, your paycheck goes down. So we got to think about these things. So it's not just an isolated question.
I'm listening to you and I'm smiling over here because can you imagine the guy or the gal sitting there, RMDs, FRAs, this, surviving benefits. What they're going, what's all this stuff mean? All right. And that's, unfortunately, that's the world that we live in. ROIs and year-to-dates and yield to returns and required mandatory distributions and early distributions.
You still like saying required mandatory distributions, don't you? It's required minimum distributions, man. But you're like, nope, it's mandatory. We got to take it. Well, and to your defense, for so long, there was a massive penalty.
50%.
Yeah, up until recently, right? Now the penalty has been reduced down to 10%. I'm sure there's... Now, I had a little hesitation in my voice, so forgive me, because whenever Congress passes a law, IRS has to go around and interpret what they meant by it. And sometimes the IRS interpretation is a little bit different than how everyone else in the world reads this. So we're going to see what that really means. But it does look like the penalties are massively dropping down, which is fantastic. So Pops would always say in there, no, these are required mandatory distributions, just really making sure people took that money out of their account. Now, on that, I know we mentioned in the last podcast, so forgive me. Secure Act 2.0 did pass. It did change inherited IRAs. And in fact, even before that, in December of last year, there was a change or clarification from the IRS's perspective on how RMDs are to be calculated with inherited IRA accounts. So if you have inherited an IRA from someone in the last couple of years, that means they passed away and left you as the beneficiary, you need to talk to a professional that understands Secure Act 2.0. The rules are now different. You could be complying with them accidentally, right? So you could be okay, but you may not be. So I'm telling everyone, hey, these rules are now different than what everyone thought they would be. Make sure you understand how it works.
Micah, that's a whole nother podcast, right?
Oh, totally.
Just talking about that. But the sad part is many of our clients and the people that we talk to have parents that put up some very structured things for a retirement plan transferring, all right, called inherited IRAs that could be withdrawn over the lifetime of the youngest individual. Those are things that have changed.
Yeah.
So just because it's there, mom and dad or grandma and grandpa may have done something that just doesn't work today.
Very, very true. All right. this podcast is all about action items. Pops, we always want to give people, as you know, action items. What are things they can do this week, today, etc., to help improve their finances? So I'll put you on the spot and kick you off. What do you got for our first action item for our listeners?
If you haven't established a SSA.gov account, do that, number one.
And that was socialsecurity.gov, SSA.gov, right? Okay.
That way you can verify what your benefits could be. And not only verify, this time of the year when you get your W-2 or multiple W-2s, compare your contributions, what was paid into Social Security, and make sure it matches what is on the W-2.
And there's other stories we've talked about before on this podcast that has negatively affected somebody. Not all the information got reported. You have a limited time. So that is a really, really good one to think about. Other one is, I would say, determine what your cash flow is going to be. What is your cash flow going to look like in retirement? How much do you want to spend? And then where is that money coming from? How much is from your pension? How much is from your spouse's pension? How much is from Social Security? And I like to call it my retirement income timeline. The next 10 years, where's that income going to flow from?
And not only that, we have to worry about the tax bracket too. Will you go, and things we don't know, right?
Yep.
Well, I'll go back to work. I'll get a big job. I won't go back to work. I'm going to live off the grid in an island off Sitka, Alaska, and not to worry about it anymore. Right? All those things play into it. So thinking about the future and just plotting it through. And, you know me. Those of you that don't know me, I like 5-year plans. I like to say for the next 5 years, here's what we anticipate. It may not happen, but if we're plotting for it and taxes go down, you win. What happens if you don't plot for it and taxes go up? Cash flow suffers.
Yeah. All right. Other thing I'm going to really recommend you do, join us on our Nation webinar. Tammy Flanagan and I are getting together on March 1st, and we have the first of a 4-part series we are putting together. That, again, our goal, helping over 1 million federal employees with retirement. So join us for that webinar, and we're learn more about your benefits. And it's not just learning about your benefits. It's taking action items that you can do something today. Just learning about it is not enough. You got to take action with everything we're talking about.
Amen. And I can't forget who said it. It's not what we think we know. It's what we know that just ain't so.
Amen. Well, Pops, thanks so much for joining us. And until next time, happy planning.
Thanks for having me here. Happy planning.
Hey, before you go, a few notes from our attorneys. Opinions expressed herein are solely those of Shilanski and Associates Incorporated, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. There is no guarantee that any forward-looking statements or opinions provided will prove to be correct. Securities investing involves risk, including the potential loss of principal. There is no assurance that any investment plan or strategy will be successful.